This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll explain how the global business of sports is getting bigger fast.
Plus, a look at the yearly Bloomberg Business Week's ranking of the best business schools in the country.
But first, this week, President Trump pushed for a 6-month reporting schedule for publicly traded U.S. companies. This would end the current quarterly format to, quote, save money and allow managers to focus on properly running their companies.
For more, Scarlett Fu and guest host Isabel Lee were joined by Michael Casper, Bloomberg Intelligence U.S. equity strategist. They first asked Michael to break down what this would mean for earnings season.
It certainly has been an idea that's been floated for quite some time among ESG circles. Even if you go back to the 2016 election, I believe Hillary was floating this idea. But it does have some validity in terms of aligning, shareholder ideas with long-term performance and management incentives, right? If management doesn't have to beat a quarterly number every quarter, they can more easily focus on the longer term. And that certainly has its merits. But again, I don't think China's the best analog to make right there.
Talk to us about the risks that semi-annual reporting could pose, because why haven't we done it? Obviously, I'm sure that our regulators and policymakers have weighed the pros and cons.
Yeah, so it's less flow of information, right? So you think about the quarterly reporting schedule, you're getting information every 3 months as an investor. You can process that information, more accurately price things in the market. And with a 6-month time frame, you lose a little bit of that, right? And obviously, I think consensus estimates will be a little bit less, let's say, accurate because they have to forecast a 6-month time period instead of a 3-month time period. So there are some bumps in the road with adopting this. But again, if it can align shareholder value with management incentives, maybe you do get a benefit out of it.
Would CEOs necessarily like this? I mean, I'm sure everyone wants to save time and save money. That was something that the president cited as a benefit of moving to 6 months reporting as opposed to 3 months. But in general, is this something that CEOs would favor?
I don't know if they would favor it. I think they'd be pretty indifferent to it. It's still the same scheme of, you've got a number every 6 months, you've got to beat that number. It's just more aligning that goal with shareholder value, right? So I don't know necessarily if they favor one over the other. They might think their life is a little bit easier trying to beat on a 6-month time frame than a 3-month time frame, but I don't know if it really affects cost too much, as the president pointed out.
Do you think that under the current SEC regime that this would actually be approved? Because to Scarlett's point earlier, and we all know this wasn't the first time this was floated, but yeah, maybe it will be approved?
Maybe. I don't know. Again, it's been a really long push of this and a back and forth. Should we do 6 months? Should we do annual even? There's some countries out there that do annual. And it really hasn't gained a lot of traction. I think investors in the U.S. are really set on the quarterly reporting schedule. They really look for those quarterly numbers to drive their analysis. And so it's going to meet a lot of resistance amongst the investor community, I think.
Yeah, especially as more retail investors are now investing in the market too. They want to hear from the companies directly, and a lot of those companies are tailoring their commentary to this new investor class as well. Not so much institutional investors, but the individual investors out there.
Yeah, certainly. You've got this huge flow of zero-day trading options and everybody trading around earnings events, especially in the retail space. That's huge. So maybe amongst the constituency, obviously they don't have as much of a lobbying voice as, your big institutional investors. But amongst his constituency, maybe there's a little bit of resistance there as well from the retail community.
Would there be a sector or industry that would benefit from a semi-annual reporting?
Oh, good question.
Oh, yeah. I don't know necessarily if I could pick a sector that would benefit the most. I think tech obviously has gained the most from the quarterly reporting schedule, right? They've done a really good job of managing their earnings and consistently beating. And, we've seen it time and time again. IBM was the bastion of this back in the 90s and early 2000s, financial engineering to beat the quarterly number. It's since I would argue it's been Apple and Microsoft have been very good at it. So I think tech's been the biggest beneficiary, so maybe they're the biggest loser.
Our thanks to Michael Casper, Bloomberg Intelligence U.S. equity strategist.
And speaking of earnings, Paul, we got results from Cracker Barrel this week.
The company offered sales guidance that missed expectations, showing the brand is still dealing with the fallout from its controversial and short-lived logo change.
Yeah, for details, we caught up with BI restaurant analyst Michael Halen.
They recorded a great quarter. Same-store sales were up 5.4% in the restaurants, a couple hundred basis points ahead of the street. But sales have decelerated pretty significantly here, since August and the logo controversy. So, thought Julie Masino did a great job. I think she's running a steady ship right now, and they're focusing on the things that they've been focused on from the beginning, which is providing better service and higher quality food at a good price point. I would say it seems like they may have sandbag guidance as well. They basically are extrapolating current traffic trends throughout the rest of the quarter. When second measure data that Bloomberg owns that we follow is showing that traffic may be stabilizing here. So I guess we'll see.
All right, let's move on to what's going on with our friends at Darden.
Yeah, Darden, it was an interesting quarter. Sales were fantastic, but slightly below, very high expectations. And the most interesting part of their report was that their margins contracted, largely due to beef costs and Uber fees, because they did this 1 million free delivery promotions supported by, Uber Eats marketing dollars, right? And so it actually made up 5% of sales, and that's very impressive for something that's been instituted, within a year. So, the margins. This company has best-in-class margins. They've always protected their margins. And so seeing a same-store sales gain a very strong same-store sales gain without the margin expansion, I think shocked some investors.
So what are they planning to do to widen those margins? I heard the portions might not be as big. Are they looking at possibly raising prices on the menu?
Well, they're going to raise prices, but not too aggressively. So they're very careful about increasing their prices. A big reason why we think they're outperforming is that they've increased their prices a lot less than competitors since the pandemic, right? And so they don't want to lose that advantage. So they are going to raise prices this year, but it's going to be modest and less than peers. You mentioned the smaller entrees. That's really a move to boost traffic. So what they're doing is they're taking 7 of their popular entrees. They're making an additional lighter menu with those 7 items. They're shrinking the portion and they're lowering the price. And they're hoping that actually brings in greater traffic with low-income consumers. So shrinking the size of the entrees isn't a major plan in terms of saving the margins. With the margins, it's going to be, executing. Right. That's what they're known for, consistently becoming more productive in their restaurants. That's how they're going to try to fund this. There will be some slight price increases. And they mentioned they could be a little bit more aggressive if, the higher beef prices remain stubborn.
Our thanks to BI's Michael Halen.
We also got earnings from General Mills this week.
The maker of Cheerios reported a solid quarter, but was cautious about the road ahead.
We spoke with BI consumer staples analyst Diana Rosero Pena.
They were mainly in line with expectations. It wasn't that much of a surprise, but still, the stock is a little bit on the soft side. People expected better news than what they disclosed.
Yeah, North America sales came under pressure. What was the drag there?
It was mainly on volume. We expected volume declines, but not to the magnitude that they did. It was down 4% on the organic part. So obviously consumers are still trading down. They are mentioning that, about 8 brands of theirs, it was positive, but it wasn't enough for the whole segment to pull through.
What are they doing? Or what are they saying about tariffs and the impact on their costs versus maybe what they're trying to pass along to customers?
So they are offsetting some of the costs with cost savings. It's usually going to be, they expect it to be about 1 to 2% of COGS this year, which is a little bit lower than, for example, Campbell's expected. They expect around 4%. So, they do not want to raise prices. They want to be competitive because obviously volume growth is not happening. So,
yeah, I mean, they're getting competition from more folks. I mean, on the one hand, they're benefiting from the fact that more people are eating at home, right? But yet, when we're going to the supermarket, more people are choosing those private label brands. What's their sort of, plan of attack there?
Yeah, so they're increasing marketing. They're hoping for innovation. They mentioned that 25% of sales growth will come in North America retail, will probably come from innovation this year. And this is what everybody's trying to get to. The problem is, and that was mentioned on the call as well, was that even the price increases are not as significant as it used to be, they're still high. So on a basket size, you're still paying a lot more than you used to 2 years ago.
Talk to us about store brands versus kind of the brands we all grew up with here. Talk to us how that's changed over time. Are store brands becoming a bigger part of the average cart?
Yes. Well, retailers are investing more on their private label. It allows them to bring people into the store. Some of the brands have a cult following, I would say. Hello, Costco.
Mm-hmm. Yep. So exactly.
So people are going to the store to buy that particular brand. They're more profitable than national brands. So obviously, there's still incentive for retailers to deploy some of their own brands.
I think some people think it's chic to buy private label, right?
Well, I don't know.
Wear it like a badge of honor.
Well, it's certainly. I was shocked at the price differential.
Yeah, because they have that pricing power, right? These stores is to, make their products a lot more attractive. Really quick, Blue Buffalo, it's their pet food. I was surprised to see that was not a leader for them.
Yeah, so Wilderness is not doing as well as they are hoping. Dog food in general has been a headwind, not only for them, but also for the overall industry. Cat food seems to be the leading indicator here, which is surprising. But
so cat food is outpacing dog food?
Yes, correct. Wow. We have seen this for the past year. There seems to be a growth in the cat population more than the dog population.
Thanks to BI's Diana Rosero Pena.
Coming up, we look at Elon's purchase of $1 billion worth of Tesla shares.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Alexis Christoforous.
And I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney, joined this week by Alexis Christoforous. We move to news from the EV giant Tesla. This week, Elon Musk purchased about $1 billion worth of Tesla shares.
And this comes after the billionaire was awarded one of the biggest pay packages in corporate history. For details, host Scarlett Fu and guest host Isabel Lee were joined by Bloomberg Global Autos Editor Craig Trudell.
There was an all-out push with Robin Denholm, the chair of the company, speaking with us at Bloomberg Television, speaking with the New York Times, the Wall Street Journal, all sorts of major news organizations about the merits of this pay package that the board is proposing. There's going to be a big shareholder vote in November on handing Musk this potentially up to $1 trillion worth of stock. There's a lot of caveats to all that Musk would have to sort of pull a rabbit out of the hat again after doing so. After a 2018 pay package where the board laid out all these really ambitious, market value and performance milestones, Musk, at that time it was kind of perceived as this moonshot pay package. He proceeded to knock them all out, and they're now calling this next pay package a Mars shot pay package. So, I think this is all sort of part of a piece, right, of trying to get investors to focus on, far out there targets, objectives for Musk that would make shareholders a whole lot of money. And it comes amid, real signs of stress for the core here and now business for Tesla, where their sales have just really struggled this year. And there haven't really been signs of sort of meaningful change in that trend even into this quarter.
Right. So this will properly motivate him. I'm so glad you brought up the 2018 pay package and some of the moonshot milestones that it laid out for Elon Musk. What was the most, I don't want to use the word outrageous, but the most ambitious of those milestones? And did he surpass each and every one of them?
Yeah, I mean, in terms of the milestones there, I mean, just even the market cap figures, I think, when they were laid out, it was just sort of unfathomable that, a car company could be, $1 trillion company. And, give the guy credit. He went out there and made it happen. I think Tesla now is trying to sort of, incentivize him to turn Tesla into a company that is many multiples of even NVIDIA, the most valuable company in the world in the here and now. And yet, the sort of path to getting there is really uncertain because, you've heard Musk make these pitches about robo-taxis and about humanoid robots, but, he is a long way from accomplishing some of these new objectives that the board has set for him.
Does Musk buying shares personally ease governance concerns, or could it even actually reinforce skepticism about how closely Tesla's board is aligned with his self-interest?
Generally, whenever a CEO or an insider of a company is buying shares, it's taken as a good thing and not necessarily, something to look askance at from a corporate governance perspective. It does, however, I think it's worth sort of, thinking about this $1 billion purchase in context. This is a guy who's, it's sort of, $1 billion can be found in his couch cushions, right? He is the top person on the Bloomberg Billionaires Index. He's worth about, $420 billion at the moment. And so, just how meaningful this is. With any other CEO, you would look at $1 billion stock purchase and maybe take real note of that. With Musk, is it that huge a show of confidence? Maybe not in the context of, just how much wealth he has.
Our thanks to Craig Trudell, Bloomberg Global Autos Editor.
Keeping with Tesla, we're going to move now to door safety.
This week, U.S. auto safety regulators open an investigation into whether Tesla door handles are defective.
This comes after a Bloomberg exclusive saying NHTSA received complaints that Tesla's design features, like the door handles, are confusing occupants and first responders.
For more, Scarlett Fu and Stacey Vanek Smith were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
Well, it is a very serious situation, serious safety situation. Now, first of all, there is a manual release from the interior of the vehicle, but the safety issue is that you can't manually override the electronics and open the door from the outside. Now, this is an issue that's plaguing the whole industry. It's not just Tesla.
Fair.
Okay. There's a number of automakers have solved the issue, and I think Tesla does need to solve this issue because people have died because of this problem here. I think from the investor's perspective, there is a solution. There is a number of vehicles, for example, the Audi. They have actually solved that issue, and they solved it by having a double pull on the latch to actually open the vehicle manually. So I think from an investor perspective, it is an issue. It needs to be solved, and it's solvable. As you know, the $1 trillion pay package and the reiteration of the company moving towards AI is really getting the investor very excited. The robo-taxi is rolling out. Apparently, the Model Y is selling really well in China. So, and then in Europe, where we saw a lot of decline in EV sales, seems to be ticking up.
But the pay package rewards Elon Musk for thinking really big, not dealing with how to unlock car doors in the event of some kind of problem. You say that Audi has solved this. Are Tesla engineers going to take their cue from Audi?
Possibly.
Really?
Yeah. I mean, it's important. It's important that they solve this because Tesla, when they roll out the robotaxi, safety is an important issue for them. And it's an important issue not just for Tesla, I think for the whole industry. And it's a reputation that they're trying to build, especially, they try to roll out robotaxi, and, they want to project themselves as a safe automaker. So I think it's going to be a priority list for Elon Musk and the rest of the organization there.
It does also seem that that people are feeling quite optimistic about this stock, but also there does seem to be a liability issue in addition to a need to solve this problem issue. Is that at all a concern?
Yeah, it is. It is a liability, and I wouldn't be surprised that there's going to be other legal issue that comes up. I think from an investor perspective, this is normal business. Recalls are normal, and there are other safety issues that has been recalled, not just at Tesla, but in other automakers. So I think the investor are taking this. I don't want to say lightly, but it's normal business that we're gonna get over this.
It's a work in progress.
Yes.
Are there other safety issues in particular that Tesla needs to focus on, pay attention to, that could, if left unresolved, could become legal liability issues?
Robotaxi. There's still a safety driver sitting on the passenger seat on pretty much on every robotaxi. I think there is discussions of taking the safety driver out at the end of the year, but I think they need to tread very, very carefully, especially for Tesla. It's a high-profile company. Anything negative is going to damage their reputation. So if they don't take up the safety driver at the end of the year, I wouldn't be surprised. I think they do need to take it one step at a time and make sure everything goes well before they do a full launch without the safety driver.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
And each week we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and agricultural sectors. This week we looked at data center demand and RE+, North America's biggest renewable energy conference.
For more, host Scarlett Fu and guest host Isabel Lee were joined by Derrick Flakoll, BNEF lead U.S. policy analyst.
RE+, Renewable Energy Plus, is one of the biggest conferences in North America. You see battery manufacturers, transformer manufacturers, energy storage manufacturers from all over the world hawking their wares. And basically what everybody is trying to do is rush to build, rush to safe harbor in order to get legal compliance to get tax credits from the U.S. government before rules change at the end of the year. Now, as a reminder, those who are following the Trump administration will recall the One Big Beautiful Bill, a big budget act passed in the middle of the year that has substantial changes for the way that you can claim tax credits. If you're a wind or solar project, you have to get under construction by a certain deadline, or you face an even harder cutoff for when your project can enter service. And at the beginning of next year, suddenly you've got new foreign entity of concern rules that could make you ineligible for tax credits based on your exposure to mostly Chinese firms, whether through corporate ownership, through supply chains, or through intellectual property and other agreements. You're seeing firms restructure themselves in order to avoid getting hit by those rules. You're seeing developers build up massive stocks of solar and energy storage in order to try and have equipment that allows them to claim those credits before the rules come into effect. And you also have massive growth in U.S. battery factories and new players entering the market to try and service more domestic demand. So you see this combination of a rush with the possibility of a cliff afterwards. And I think everybody's waiting for new rules to come out to provide some clarity on exactly how much the market can survive this shift.
How anxious were the companies and the executives at this event? Because, as you mentioned, they are moving quickly because the rules could change on them. The goalposts could change at any point. What is the one certainty that they have in operating and through this uncertainty?
I think the one certainty that they have, besides that more change is coming, is that there is going to be load growth in the grid as a kind of tailwind supporting the market in the face of other headwinds, right? We all know that data centers, among other applications like new manufacturing and electrification, are causing electricity demand to rise for the first time in the U.S. in about 2 decades and at very fast, kind of chunky rates. So that in turn means that electricity prices are going to have to go up, especially given that the tax credits that were sort of subsidizing new power build are going away, or at least being severely reduced. That in turn is going to make the economic case work out for more projects. But that is filled with uncertainties in and of itself, right? You have different utility markets, different states trying to change the way that power is paid for by large load customers like data centers, and where the cost falls, how many projects get built, how much public utility commissions allow, given the cost increases that most ratepayers are going to see. That's a source of uncertainty even within that certainty. uncertainty. And so you see at RE Plus, there was a lot of talk of virtual power plants or special timing on electric vehicle charging, anything to sort of keep the electricity system from being overbuilt. Because as a reminder, the way the electricity system is structured is for the hottest and coldest days of the year when there's the largest amount of electricity demand. A huge amount of cost is driven by that, and there's extra capacity that goes unused a lot of the time. People are trying to get creative about how you use more capacity that's already on the grid to prevent things from getting more expensive for customers. Or if you do need to build new stuff, basically putting those costs onto data centers themselves. Nevertheless, there is still a key tailwind in the face of this policy uncertainty. It's just a question of what that actually means for every other customer.
Our thanks to Derrick Flakoll, BNEF lead U.S. policy analyst.
Coming up, we look at how the global sports industry is huge and growing rapidly.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Alexis Christoforous.
And I'm Paul Sweeney. This is Bloomberg.
As veterans, we're no strangers to helping others.
It's what we were taught, trained, and told to do.
It could be for anything. Helping a friend move.
Listening to a fellow veteran for hours, at any hour of the day.
Or just simply making time for people. A neighbor, a loved one, or even a stranger.
We're often the first to help others. There's no question about it.
But we do have one question for the veterans listening.
When was the last time you reached out for help?
Perhaps it's time to do for yourself what you would do for others.
If you or someone you know needs resources, whether it's for stress, finances, employment, or mental health, don't wait. Reach out.
Find more information at va.gov/reach. That's va.gov/reach.
Brought to you by the United States Department of Veterans Affairs and the Ad Council.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
I'm Paul Sweeney, joined this week by Alexis Christoforous. Franchise valuations are surging across the $2.65 trillion global sports industry, with three-year annualized growth rates running at a double-digit pace across the majors.
A loosening of ownership restrictions is driving an influx of institutional capital into professional sports franchises, enabling access to a deeper pool of potential investors.
We broke down the numbers with BI analyst and Business of Sports co-host Damian Sassower.
$2.65 trillion is revenue generated or expected revenue to be generated just this year alone from the global business of sports. So let's put some color around it. And really, it's everything from the $60 billion a year that's generated from media rights, the $30 billion in advertising spend. But if you want to take that $2.65 trillion and it's recreational vehicles, it's apparel, it's everything. What we focus on is fan engagement. And fan engagement is roughly $750 billion in revenue generated per year. And there's no better mechanism to take advantage of that segment than to own a professional sports team. But not everyone can own one, right? They're privately listed, they're not publicly listed. They're private entities. You just can't invest in them easily. So together with Brianne Dougherty, Geetha Raghunathan, Kevin Neer, and the whole team here at BI, we came up with some ways that your everyday investor might be able to take advantage of the opportunity set in the global business of sports. And we wrote a huge research report on it, and it's really good.
We did watch your 12-minute segment. And then you said that the difference is the sports industry has limited public access. Is that for the better?
So it's changing. So the rules changes specifically with regard to private equity investment in the NFL. I mean, the NFL is first among equals. I mean, their national media deal is 11 years, 110 billion, something along those lines. It's 12 billion in average annual value per team. It dominates professional sports. But really, at the end of the day, what you are seeing here from some of the recent transactions that have taken place in the private space, I'm talking the Philadelphia Eagles, the Buffalo Bills. A lot of these teams have sold small minority interests in their teams to private equity. It's driven the entire universe higher. So to put some numbers around it, since year end alone, the average NFL team has gone up by 35% in valuation. So the top 25 teams across all of professional sports, I'm including international sports like soccer, the NFL now comprises 22 of the top 25 slots alone, led by the Dallas Cowboys, of course, but the Jets are up there. So it used to have a spattering of NBA. Yeah, right. Despite their best efforts, Scarlett. But you used to have FC Barcelona, Real Madrid. You have, some baseball teams like the Yankees, Dodgers, and Red Sox that used to be up there, and a lot of them have kind of fallen back due to the fact that private equity is now allowed to invest in the NFL.
Okay, I mean, private equity being allowed to invest in the NFL was definitely a watershed moment, but private equity was allowed to invest in European football clubs for a lot longer before
Very
this.
different sport, yeah.
Very different sport, but I'm curious in terms of the breakdown of that $2.65 trillion number. How much of that is tied to the NFL? How much of that is tied to things like European soccer?
Well, I mean, it's a much smaller percentage than that, right? Because, I mean, that $2.65 trillion that's generated a year, I mean, again, it has everything to do with recreational vehicles, the footwear and apparel. But if you're just talking about a sports team and how they generate their money, it's just really national media rights or local sports media rights. And it's gate receipts primarily, ticketing, parking, concessions, the things that you pay for when you go to an event, right? So, if you just want to talk about gate receipts, I mean, 162 game schedule for the Major League Baseball, they dominate in gate receipts. But in national media rights, which is the real animal that everyone's chasing right now. You hear about the NBA's new media rights deal, F1, UFC, the Major League Baseball just did something new there as well. It's the NFL. I mean, the NFL is first among equals in national media deals. It represents 75% of every team's average annual value revenue that's generated every year. So, yeah, these national media deals are huge. And now that the NBA just did its big deal, we expect that, come, I believe, 2028, Scarlett, the NFL is going to re-up. It has the ability to buy out of its existing contract and renegotiate it. And it definitely is going to do that. And I think that's what's commanding a lot of these valuations, because investors, specifically private equity investors, they see this and they want to take advantage of it.
Can you talk about the revenue mix? Because it varies across major leagues. I'm looking at this really pretty table you have. For NFL, the biggest driver is national media.
Yep.
For NHL, and I'm eyeballing here, it's ticket sales. And it seems like concessions/parking, who would have thought, is kind of a significant chunk across all of them. What do you think will be the single biggest driver, or is it really going to be different?
Well, that's only because the average franchise value to revenue multiple for the NHL is just 7.7 times. I mean, in the NFL's case, it's 12.5 times. In the NBA,
NFL is in a league of its own. Nothing else even compares, right?
Correct. I mean, but you might argue, I mean, look, despite the fact that the NHL generates, call it, I don't know, $2 billion in revenue per year on average, its multiple is still smaller than that of Major League Soccer, which generates much less. And again, that just has to do with the fact that you have all these MLS valuations now on the back of, some great European players like Messi, who are now coming to play in places like Miami, just driving up a lot of these valuations. And so, we're still in early days, but really it's the entrance of institutional capital, Isabel, that's really driving everything higher. For the first time ever, institutional investors are gaining access to these sports teams, and they are looking to, get a high return on investment from them. And just to be very clear, you mentioned soccer before. Because of relegation and all these things in soccer and the fact that there's no salary cap, it's very, very difficult to extract a profit from owning a EPL team, a European Premier League team, whereas the salary cap allows for, better profit generation in the U.S. And so I think that's one element of to why you're seeing a lot of the valuations for these Real Madrid, FC Barcelona come off relative to the NFL.
So owning a European soccer club is more about bragging rights than actually making money. Is that what we're saying?
I would say, no, not entirely. I would say, yes, it's definitely a trophy asset, but they all are. I would just say the playing field for soccer, the fact that there really isn't any way to, to just cap with look, Middle East money that's come into a lot of it, it's just very, very difficult to extract a profit and continue to pay these players and compete for these salaries with the likes of Man City and some of the others who have really, really deep pocketed investors. And I think that's what's kind of skewing all the revenue generation, all the valuation multiples to the downside in Europe.
Any projection or outlook on the future of esports?
So esports and sports betting are two of the biggest drivers of our, so Bloomberg's created the Bloomberg Eco-Weight Sports Basket, which is a way that your average sort of investor can take advantage of any number of publicly traded stocks that have, exposure to the sports industry. And Bree Dougherty and her team have done a great job of developing this, and sports betting and esports are, such a big part of it. And esports, especially, if you look at the purse from like I'm not an esports, expert here, but Nathan Naidu, my colleague in Singapore, is, and he said that the purse from like the World Championship of Esports is on par or higher than that of Wimbledon. I mean, can you imagine? Higher than the Masters here, and I'm talking golf here. It's just amazing how much money is being funneled into that specific sort of subsector of the sports industry, and it's growing. It's growing at a CAGR of like double digits over the past 5 years, which is just astronomical, and I think there's more to come.
Our thanks to BI analyst and Business of Sports co-host Damian Sassower.
This week, Bloomberg Businessweek reported in their annual ranking of full-time MBA program that Stanford Graduate School of Business is again number 1.
Why Stanford? Host Scarlett Fu and guest host Stacey Vanek-Smith were joined by Dimitra Kasenides, Bloomberg News senior editor.
Stanford came out top of our U.S. rankings. We have rankings across regions, so it's not globally the number 1 school, just to clarify. But it certainly points to resilience and strength of the programs. Stanford, as we know, in Silicon Valley, with all its focus on technology and entrepreneurism and more, has been very, very strong for years. That maybe to some degree masks some of the problems that we see that especially in the U.S., but globally, schools are confronting. I mean, there are a lot of challenges today. There are geopolitical challenges. There are challenges that are more specific to the U.S. with what we've seen play out over several months, given the current administration stance towards international students, towards issues of diversity. So there are certainly a lot of things that are just making tensions a little heightened right now, and are really raising the level of discussion and concern among deans in a way that has them trying to come together from around the world and really think about how do we best support each other to support education, because what we ultimately are in the business of is education.
Well, clearly some of those challenges have to do with some of the Trump administration's policies and stances going after certain colleges and universities. How has that factored into business schools, to enrollment, and to some of the concerns that you're mentioning that deans of different business schools are taking on?
I mean, it's starting very slowly. It's not as though we're seeing some great exodus from people interested in schools in the U.S. We still have a very strong system of business schools in this country, also in Europe and in Asia. And there are very particular facets to each of them that appeal to students depending on what they're looking for. But I think that international students who have come to this country in very large numbers to business schools are starting to really question whether this is the best option for them, given the opportunities available elsewhere. And part of that mix also has to do with factors that aren't so specifically about the administration right now in the U.S., but about jobs and opportunities and growth. Our schools in the U.S., in addition to some of the factors that they're facing that are more about some of these issues around diversity and international students, they're also confronting a situation in which, more graduates are finishing their programs with no job in hand.
Yes.
The share of students that are finishing and that have a job offer within 3 months, while it's not, again, a huge shift, but it is a shift we're seeing, is really, that sort of percentage is being cut away at. We've seen so many cuts in technology. We've seen cuts in many other industries that are leading. Consulting is really a big one that draws business school students historically in very large numbers. Consulting is going through a huge shift right now, largely because of AI. We've seen many stories about this, the way it affects the work that they're doing, the way that they're recruiting, how many people they need to hire. So it's affecting all schools in various ways. International programs have a lot of partnerships with U.S. programs.
Right.
U.S. programs send a lot of students abroad. The visa issues are also, very, very touchy right now. So it feels like it's on many fronts and just coming together in a way that's more sort of pronounced.
And our thanks to Dimitra Kasenides, Bloomberg News senior editor.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Alexis Christoforous.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.